Greetings, everyone. Welcome back to the channel. Okay, today we're going to talk about market structure. And this is really an introduction into technical analysis. All technical analysis needs to be rooted in some sort of market structure as the background, as the foundation. So it's a great place to start learning about the market and learning how do you actually read a chart, which is the most important thing when you are trading options. You need to know how to read a chart, how to identify trends and identify targets. Before we get deep into that, I want you to think about the market as an ocean, right? When you think about an ocean, no matter what's inside the ocean, whether it be a ship or marine life or even a surfer, right? Or someone trying to swim in it, everybody inside of that ocean must submit to it. The ocean does not submit to the ship. It doesn't submit to, the person out there trying to catch a wave. I mean, if they catch a wave, great, but it's not submitting to them. They have to submit to it, right? And not to get all nautical, but when you hear things like going with the flow, what that means is like you're letting the current conditions dictate your movement rather than fighting against it. And even thinking about this, like as a ship captain, you know that you're looking for whether you have high tide or low tide. Well, why would that matter? Well, when there's a high tide, that means there's more water. You can get into deeper places that maybe you won't be able to get to in a regular condition, right? And it's the same thing with low tide. You need to know that because your water levels are going to drop, and then you have a lot more hazards. You have a lot more things that could get you stuck. And that's the cool thing about a tide, right? When you think about it, tides create currents, right? And the current in the water really can affect your speed and efficiency while within it, right? You'll actually move a lot faster with less effort if you go with the tide or go with the flow, right? But if you go against it, that's when you got to use more effort, more horsepower. And in these conditions, this is where accidents happen, right? So now that we've gotten our nautical lesson out of the way, let's get back into the market. Let's talk about market structure. But it's really the same thing, the same idea, where we want to be going with the trend. We don't want to be fighting against the trend. So I guess your next question is, what's a trend? Okay, well, there's three types of trends within a market, within the stock market. And the first one we're going to talk about is an uptrend. Now, an uptrend is identified as bullish. And in a bullish market structure, you're going to have a series of higher highs and higher lows on swing points, right? So let's look at the chart here. Initially, you put in a low and then a high. But that next low did not take out the previous low. So that made it a higher low. And then when it went back to the upside, it actually took out the swing point to the left of it, which made a new higher high, and then so on and so forth, a higher high, higher low. Okay, before we move on to the next type of trend, let's talk about what swing points are. So a swing point is basically a pivot point that represents the start or the end of a new price wave, right? And there go that wave again. We talking about the ocean again, you know what I'm saying? See, that's a dope analogy. But anyway, let's keep it going. So these swing points are what we use to identify the trend direction, okay? And when you look at any swing point, let's take a look at a swing high here. What you're looking at to confirm that it's a swing high is you need the candle to the left of it and the candle to the right of it to be lower than the middle candle. That middle candle will confirm a swing high by those conditions. Well, it's the same thing in the opposite direction. You confirm a swing low by the two candles to the left and the right of it being higher, right? So with those being higher, that middle candle confirms a swing point to the low side, right? So that's pretty much it. You're looking at, okay, the market is moving in waves. It doesn't move straight up or straight down. It actually moves diagonally. So these swing points are key identifiers as to where we are in price and what trend we're in. Okay. Now let's go to the bearish market structure or a downtrend market. All right. So in that market, you're going to have your initial high and low. But when it goes back to the high, it's actually going to make a lower high and not take out that swing point at the top. Okay. Then it's going to take out the previous low by making a lower low. And then again, it won't breach the previous high by making a lower high. And that confirms your downtrend. Okay, so let's talk about the third market structure. And this one is the most dangerous one. This is like that hurricane in the ocean, right? If you're from New Orleans, you know what I'm talking about. But if you're from around the world, you can think of it like a tsunami, a bad storm, whatever. Something that is disrupting the path within the ocean. And that's when we're going to talk about the ranging market structure. Okay, so when prices is in a range, what it's basically doing is it's going back and forward. Now, in trading, we would call this choppy market conditions, right? Just like if you were in a storm in a boat, you would have like choppy water. And the only thing that means is that price is going back and forward. It's not really creating new highs or new lows. It's just within a range, bouncing back and forward between a small price point, right? And within those conditions, you must avoid it. The main reason for this is that price is indecisive at this moment. And we don't know if we're going to go higher or lower. Honestly, there's really no confirmation of what price is doing. And if we don't know what price is doing, there is no trade. You have to avoid it at all costs. Just like that shipping captain. He's not going out with a Category 2 hurricane in the middle of the Atlantic Ocean. And if you decide to go out and trade in these conditions, well, you would have the same thing happen to you that would happen to a captain if he bought a ship out into a hurricane. You would get wrecked, clapped, or capsized. The point is, avoid these at all costs. Wait for the market to tell you what it wants to do. Submit to the time, submit to the patience of, okay, if I can't look at this chart and see, okay, we're in an uptrend or we're in a downtrend, I'm just going to wait. Or I'll go look at another chart. Or I'll still wait, right? Because waiting is probably 70% of the battle when you're trading, right? Because when you open a chart, you're going to want to see something, but there may not be anything there to see. You know what I'm saying? It just might not be nothing there to see. I know you want to make your money. I get it. We all do. But if you're in a ranging market, you will not make money. Period. Okay. So now that we've talked about the three types of trends, which is an uptrend, a bullish market structure, a downtrend, that's the bearish market structure. Unless you have that ranging market structure that we just talked about that we're going to be avoiding. All right, so let's jump back into the swing points and how we can actually use them to identify where we're at in price, right? Because that's important to know where we're at in the move and to be able to find a good entry. Okay, so if we have put in this example on the chart here, if we've put in a swing low and a swing high here, and then we go back and then the next swing low doesn't take out the other low. All right, so what type of market structure does this present to us? That's right, a bullish market structure. All right, so we're looking for an uptrend here. All right, so once that swing low is confirmed, this is a good time to start looking for an entry and also looking for where we're at in price. What do I mean? Well, if we've already breached the swing high, that's kind of like a danger zone. Why? Because usually above swing highs and swing lows, that's where you're going to have your support and resistance. Okay. And that's an entirely different video. So we're not going to get deep into that, but let's just say this. What support is an area in which price has in the past found a place to pivot. All right. So from that point, it was making a new low and it said up, like that's when buyers stepped in and pushed the price back up. Right. So that's a support level. A resistance level is a level when price was moving high and then the seller stepped in and said, nope, I'm ready to get out. I'm ready to cash in my positions. Right. So there's resistance at that level. Right. So that's when you're talking about support and resistance zones. That's the basics of it. Again, in a later technical video, we will go over it. Back to this lesson. So look, the swing low has been put in and we have confirmed that that's a higher low and we're in an uptrend. All right. So now our antennas is up. And what are we looking for? We're looking for where price is currently, meaning we don't want to kind of buy in after that swing high has been breached, because we know that a pivot could be coming in the near future, right? Because price doesn't move straight up and straight down. So once an old high is breached, there is liquidity above that zone. And what may happen is it may pull back before it continues its way back up. It may put in another higher low before it puts in that higher high. Now, in our first video, we talked about liquidity and what it means, and that's where old orders are sitting at, right? So above old swing highs and old swing lows, there's liquidity there because that's where people have stop losses placed. That's where they have limit orders to buy back in, right, or to sell. So when we get above an old swing high, you got to kind of have your antennas up and say, okay, when can the pivot come? When is the pullback coming? Okay. And that's why if we're getting in, there's two ways you can enter. The basic way is, okay, a swing low has been put in, a higher low. I'm going to wait for the candles just to move a little bit away from the swing low, maybe like 2 or 3 candles to confirm, and then boom, I'm in, and I'm going to target that old swing high. All right, that's your first way to do it. Your second way to do it, the more advanced way to do it, is to wait for that swing high to be breached and for a new swing high to be put in, and then let it pull back to that old swing high point, right? And that's going to be where your higher low is put in. At that point, boom, then you take it and ride it all the way up to the new swing high. All right. So that's the two ways you can look at it. You can literally get in the beginning. As soon as that low is put in, you get a couple confirmations, right? Make sure you're not getting faked out. And then you can roll with it. That's called more or less momentum trading, which isn't a bad thing because that's riding the wave. Not necessarily what I use, but it is something that is useful. What I use is I wait for pullbacks, right? So I know where we're at in price. I know that we're in a uptrend, and I know that we have just put in a higher low. Cool. So I'm going to let that old swing high be breached. Let that swing high be put in. Bam. And again, that's a good trade if you take that trade. But for me, the better trade is, okay, let it come back down to that zone, that old swing high, right? Let it pull back into it. But of course, it's not going to breach the swing low because we're in a uptrend. As soon as that swing point is put in, I'm in. Now I'm in because I've confirmed that, okay, we had a higher high and a higher low, then we breached the high. Now I'm on that third wave and it's like, okay, I'm pulled back to a great point and then I bounced off of that. From that point, I can ride it up to the new swing high and take profit. So that's why it's important to know where we're at in price, because not understanding where you're at in price will put you in a position that perhaps you're looking at the chart and the chart is running. And if you don't look to your left and see, well, hold on, has a high been breached? Because if it is, a lot of times people will buy in closer to the top and then it'll reverse on them and stop them out when they had the right idea that it was going up. But it has to not only be the right idea, it has to be at the right time. Speaking of time, let's talk about full time frame continuity. All right. Before we can do that, let me give you a few points in which you want to have time frame alignment. Okay. So if you are looking and using the ones at the top, those would be considered your higher time frames, right? So that would either be the month, the week, the daily, or the 4 hour chart. Those are considered your higher time frames. Okay. And then when you look at those, there's a time frame that would be like the midpoint, and then the lower time frame that coincides with those. Now for the month, you're going to go to the day at that midpoint, and then the 1 hour for your entry. It's the same thing with the weekly. You're going to be looking for the weekly to understand, okay, where we're at in price, what's our ultimate goal. That 4 hours is going to confirm the trend for you. And then that 15-minute is going to give you your entry. So on and so forth. You got your day, your hour, your 5 minute. And the one you're looking at really aligns with the type of trader that you are. Are you a day trader? Are you looking to get your 20 to 30 to 40% today in this one trade? Well, if so, you're going to be more concerned with the daily chart, the 1 hour, and the 5 minute, right? Because you're not here for the whole party. Whereas if you're swing trading, that's an entirely different story. And that's when you're going to want to go to your higher time frames like your weekly and your monthly and confirm that you're in alignment and you have continuity, meaning on that higher time frame, you have an uptrend. On that middle time frame, you have a confirmed uptrend. And even on that lower time frame, you have confirmed that you are still in a current uptrend, right? And that's what we mean by full time frame continuity, right? So if they're all saying the same thing, if all the soldiers like, look, we going this way, this is what we're doing. If you have everybody on the same page, that's when you want to get involved with the stock. And that can be in an uptrend or a downtrend. Doesn't matter. As long as they're all saying the same thing, then this is a higher probability trade, and you're more than likely to have a successful outcome. Okay, that's going to do it for today's lesson. Look, please like and subscribe for more content like this in the future. And with that being said, y'all have a blessed day. Catch you on the other side.